All right. Hey, everybody. Welcome back to We Talk Money. I'm your host, Chris Dunn. I've got Travis, former hedge fund investor, turned to the dark side. We've also got Nikki, who's a certified financial planner. And we're going to start today's show with a quiz, or at least talking about a quiz that I recently did on the Twizzler. I was curious where people are at in their investing journey. And the four options here were people who are just getting started, or compounding aggressively, basically in wealth building mode, or were they in capital preservation mode, right? They built their accounts to where they want to be, and now they're more risk adverse, and they just want to hold things up and not take on massive level of risks, or wealth distribution. Basically, you're in retirement, you have no active income, you're not trying to build anything anymore, you're actually drawing down on your accounts. And I thought it was interesting that over 50%, I'm actually not surprised about this, but over half of the people, almost 500 people that responded to this said they were compounding aggressively, where a quarter were just getting started. And then about 20% were in capital preservation mode. Congrats to you guys who have kind of quote unquote made it. And then maybe 5% were in that wealth distribution phase. Where are you guys, Nikki and Trav? Are you guys aggressively compounding, or are you more in the preservation phase, or where would you say you are?
Compounding aggressively. Trying to, at least.
I'm always trying to compound, that's, I think the old Warren Buffett quote, right, is that you want to get rich slowly. It's always better to get rich slowly. So I'm just trying to compound at 20 to 25%, a modest compounding rate that will hopefully 10 to 20x capital over, a decade timeframe. I always wonder with these surveys too, how it changes during market cycles, right? Like if you'd ask people in January of this year, you'd probably have 90% compounding aggressively. Now you probably have a few more people trying to preserve capital. We've seen a really big shift in the markets this year, at least in stocks. So it'd be interesting to see how many people will move to capital preservation mode if we get a deeper bear market. But I'm always trying to compound, at least at this stage of my life. So we'll see.
Yeah, there was a response too that said, it depends on the Bitcoin price. I think that's true. It's like when, prices are in the dumps, a lot of people, instead of at that time trying to compound, they're in the risk aversion mindset when they need to be like risk on. So it kind of goes back to the idea that most people do the opposite of what's profitable. But it's always interesting to think about, I guess, Nikki, as a financial planner, you talk to people that are in these different stages of life. And as, I guess, addicted investors as we are, always looking to compound, we don't really think about the fact that there are people that are like, you know what, I don't really need to grow anymore, or I'm actually taking money out of my accounts. But that's what a lot of people in retirement do. I don't know. Do you have any other thoughts on that before we jump into the charts?
Yeah, I mean, typically it depends on, where you're at in terms of your career and your age, and, usually what stage of wealth, of your wealth life cycle you're in. Usually it's dependent on that more so than the market cycles. But I can see how some people may change what stage they're in based on what the market is doing. But, typically you will have, I guess, ebbs and flows within each cycle. Like if you, like Travis mentioned, if you're in the compounding aggressively stage, you're young, you still have a lot of time left. But hey, if the market is pulling back, you may have to shift strategies or change things a little bit to conserve capital or protect capital. But typically those stages are going to be based on your age and where you're at in your career.
Yeah, good point. All right, let's do this. Let's jump into some charts, talk about the markets, talk about what's happened over the past week or two. A lot has been happening in the markets. And I think the theme right now, if I were to try to label this at a 30,000 foot overview level, is things aren't as easy as they were last year, right? Like last year, everybody was a genius, both in cryptos and stonks, right? Like throughout 2020 and then the first, I guess, like half of 2021, the markets have just been in a really strong bull rip, but things, at least in crypto land, have gotten a little bit more choppy. We're still in what I call popcorn season, where you're getting a lot of things that are still making massive gains, but it's not like the shotgun approach where everything is going up, right? In fact, if we look across the board at a lot of crypto markets, there's a lot of things that are actually red kind of on the month and the week, and just a lot of choppy charts out there. And Bitcoin is on the bleeding edge. And I think this was actually the headline of our last show, was the markets are literally teetering on the bleeding edge. And we've seen a pretty deep pullback in Bitcoin, which is down, or as of a couple of days ago, fell about over 35% from the new all-time highs around 69K. And if we jump over and look at the screener of crypto assets, you can see it's kind of a mixed bag, right? If we sort by the largest, you can see a lot of things are down on the week and the month, but still up on the year. And so we're at this inflection point where I think we're close to either shifting into kind of a medium-term bear market, or if we get a V-bottom bounce, the bull market, in my opinion, would still be on. But we really are at that inflection point where, this is where I kind of zoom in and start to focus and really start to think about, hey, how can I participate in the biggest upside while also managing risk? And so I've been looking for new setups. I've had a couple of new trades come on over the past week or two, but I am definitely more in caution mode right now. Trav, what do you think about that idea in stocks, and how have you been thinking about managing risk in today's market?
Yeah, it's a great question. So obviously we've seen a lot of volatility in stocks over the past 2 or 3 weeks. The market has really punished growth, small caps, recent IPOs, et cetera. And it shouldn't be that big of a shock to people. We've been talking about since the beginning of the year that, there's a potential for a market shift as we see a shift in what the Fed is doing, a shift in the inflation/deflation narratives. And of course, you still have like the COVID stuff out there as well, which is an X factor. But, there's this big shift underlying, what investors want to hold in their portfolios the next few years. If you believe that there is a shift in the Fed policy, for instance, when you look back at like the last, I think, 50 years, and I think there's like 20 or 25 Fed tightening cycles, that tends to lead to multiple compression in stocks, valuation multiple compression. So it leads to valuation multiple compression for a lot of stocks. It also leads to heightened volatility. So, I say we shouldn't be that surprised. Of course, it still is surprising when you see some of the depth of some of the moves that we've seen, but it's not a surprise to me that we'll see a shift potentially in what investors want to hold in their portfolios and what delivers return, especially, what delivers return versus risk. You can take big, crazy risks out there in the market and always, find home runs. But, if you're looking at an overall portfolio strategy of trying to compound and reduce risk, then I think you have to be thoughtful about what's in there. You can't just hold an entire portfolio of recent IPOs or an entire portfolio of the highest valuation tech stocks if you expect to weather that type of volatility. So, for me, to your question, I think, what I always try to do, and what I've said, I think on the show over and over, is to try to create a portfolio that can be balanced enough to kind of perform through all market cycles, and then try to figure out which assets within each bucket in the portfolio are going to outperform. And so that's still what I'm trying to do. I don't try to change that core part of the strategy. I may take some asymmetric trades here and there. I may try to take some opportunistic stuff whenever the market is giving it to us, but trying not to get too overextended on my skis, but still retaining plenty of exposure to the stuff that I think has a lot of upside.
Well said. Nikki, you put together this chart from Y Charts, which, by the way, Y Charts is a sponsor of the show. So thanks to Y Charts. Do you want to explain kind of what we're looking at here? And maybe this is also a good look at the theme of the stock market right now.
Yeah, I mean, growth has been coming in a lot. Growth stocks were the darlings of 2020. It was super easy to make money trading and investing in these growth stocks since 2020 started. And we're finally, there were many times where on this podcast, Trav and I specifically mentioned that these, valuations, we still care about valuations, even though the market seems like they're going to buy it at any price. we still, we're trying to stick to our strategy and to our values when it comes to our investing. And, I look back at that and I look at how far some of these names have come in terms of, this is actually the enterprise value to revenue multiple, which commonly is used for valuing growth stocks. And basically a lot of these multiples have been compressing and coming in quite a bit from their highs. You can kind of see that represented on the right side, how deep how much some of these multiples have come in. Some notable ones, I think it was Zoom. I think DocuSign was a pretty notable one recently. We saw DocuSign drop, I think it was 40%, give or take, recently on an earnings release. And this is a company that's still growing at very healthy rates, but the market, drove it up, and the valuation drove up to a pretty high level. And so once that growth started to slow down or decelerate, this is what we're seeing. This is what's happening. And we, now DocuSign could be something that, I might be interested in buying, and I might be paying attention to it now. I like the blood. I like seeing this. But it just goes to show you how valuation still matters. And as much as Wall Street Bets wants to say that it doesn't, it does. And, this is just, we're kind of just seeing it all play out in real time, how some of these stocks, they're just coming in quite a bit. They're getting hammered. And it's astonishing to see the price action in them. It's astonishing to see these deep corrections. But when you look at the valuation still, it makes a lot of sense. And they could even see even more valuation or even more multiple compression going forward, especially if things like, when the Fed comes into the picture and starts raising rates. Travis has mentioned this a lot, the risks that are still kind of out there for some of these names. So yeah, I think that's kind of where we're at. And investors are losing their shirts because they ended up buying at any price. And this is the price that you pay for that. And this is why, we do what we do with the fundamental analysis. Go ahead, Trev.
Oh yeah. That DocuSign example is perfect. It's, just a prime example. We've seen so many during Q3 earnings season where they've gapped down massively on a small earnings miss, but the company's still growing at a very, very nice rate. And I saw people on Twitter, investors who have invested in these types of stocks saying, like, how can this be? How can the market price this company 40% lower than it did the day before, even though it's still growing at 30+% a year and numbers still look pretty good overall? And, they missed guidance by 1% or whatever it was, right? Some small margin. And it's like, well, the fact is, like, it was priced for perfection. And even though you have a good underlying business that's growing at high rates, it doesn't mean you can pay any price. And I think that's where a lot of people get tripped up. And so, even, ARK, we could talk about ARK, right? The darling of late last year, early this year, Cathie Wood, she was on CNBC every other day. People were piling into her ETF, and people would ask me, what do you think about her? And I'd say, well, I actually think she's pretty reckless. Like, the way she's constructed her portfolio, the way she trades around her position is just really strange and really risky. And, she goes on and she makes the claim that, well, we believe in the long-term vision of all these businesses that we hold. We're long-term holders. We, believe in the growth of these businesses. These businesses are the future. Well, maybe they are. Maybe some of them are, at least, but it doesn't mean you can pay any price. The other strange thing about what she does, she claims to be a long-term investor focused on innovation in the future, but she trades around her positions so actively. She'll be buying a recent IPO at the top, and then it's down 20%, and all of a sudden she's selling it. And it's like, well, if you believe so much in the long-term future of that company, why are you doing the exact opposite of what you should have been doing? So This is a great chart that Chris is showing here, which shows that even though ARK can say that their 5 or 10-year performance on their ETF is really good from a percentage basis, the majority of investors in ARK's ETF now are actually flat or maybe even down a little bit. We use what's called a money weighted return. What does that mean? How can that be? Well, investors piled in most of their capital into ARK's funds at the beginning of this year, not 5 years ago when ARK first started, right? So most of the investors have actually enjoyed negative returns as this fund has plummeted in the last 6 months, because most of the investors in ARK just got in, this year. And so they got in all of the flows, when the fund was at its top, basically. And then now that the fund is seeing massive drawdowns, investors are starting to actually get out of the fund. So it's like the classic example of buying the top and starting to sell down on, on the lows. So
and
don't
isn't
be that
typical of yeah, isn't that typical not only of like investors buying a stock at the top, but chasing fund performance, right? Like you once you hear about a fund or some popular investor that has a really good recent track record, all the capital flows into that, and typically they underperform in the future, right?
Yeah, there are, of course, some counterexamples to that, like Warren Buffett, Mark Leonard at Constellation, some of the best fund managers of all time, Tiger Global, for instance. These funds continue to do well even decades after they've taken in a lot of capital and put up returns. But there are a lot of other funds that are, the hot thing of the day. We saw this in the dot-com bubble. Funds like the Janus funds took in a bunch of capital, were invested in nothing but bubble stocks at, nosebleed valuations, and then were almost wiped out in the 2-year bear market following. So you have to be thoughtful, I think, if you are getting into something that is hot, whether it's a stock or a fund or a crypto, like you've got to think about what is the price I'm paying and what is priced in already. Stock market investing particularly is what we might call like a pari-mutuel game, where everyone knows which companies are the quote unquote best companies growing at the highest rates. So you pay a premium for those. Everyone also knows which companies are not growing or maybe even shrinking or losing market share. And those trade at just absolutely distressed multiples. And so the question is, do you take bets on stuff that is, high probability to keep growing, but very, very high prices? Do you take bets on stuff that's low multiples, but maybe crappy? Or do you find in between? Do you try to look for, maybe the stocks that are growing at a reasonable rate, but priced for maybe not as rich valuations, right? So like there's this whole idea that similar to like betting markets where, the stuff that's known is going to be priced into a great degree. So how you play those probabilities is really, really important. Investing is tough. We are reminded in markets like this that it's not an easy game, because it is a game of expectations and trying to predict the future.
I will say this. Yeah, sorry. I want to kind of piggyback on this in this ARK situation and what you said, Travis. I mean, I think that a lot of people that were getting into ARK, it's an ETF, right? So people might be thinking passive investing, long-term innovation investing, but people need to realize that ARK is an active ETF. I mean, the turnover ratio is, I think, 71%, which means they're coming in and out of positions a lot within a given year. That is a very, very, very high turnover. An S&P index fund has a very, very low turnover, I think maybe 1% to 2%. So look, ARK is a actively managed ETF. And people that got into this, maybe they weren't paying attention. Some of her transactions that I saw go on over the past year and a half, I was even thinking to myself, what is she doing? And I think I even talked to Travis about this one time. I was like, Trav, I'm looking at these transactions. I'm like, what is she doing? I mean, she's buying these things or her team or whatever. They're buying these things at these crazy valuations. I mean, and the thing is, you have to pay attention to the objective of the fund. And the objective of her fund is it's an active fund for one, and it's all about innovation. And innovation was getting pricey, right? So I think that many people that got into this ETF maybe didn't realize some of those things, and maybe they weren't paying attention to those transactions or to the fact that it is actively managed and has a high turnover ratio. And what we know is the higher the turnover, that has a drag on overall returns. I mean, there's data showing that over and over. So I think that, when you are going to actively invest, this is why it's so important, to this ETF, she has an objective she has to fulfill. She's got to do it. She's doing the thing, right? But you as an active investor can approach it with much more elegance and tactfulness and research and, paying attention to valuations and constructing your portfolio the way you want it to be. And I just think that this ARK ETF, sure, maybe these things are going to high fly again, and she's going to see mad success in the future. But I just don't know. The way I've been seeing her kind of trade in and out of positions, I'm not sure. And I've definitely had my doubts about that ETF.
And yet, despite all of these deep pullbacks and a lot of the high flyers from 2020, the NASDAQ, which is primarily made up of tech stuff, is right at or near all-time highs. What do you guys make of that? And also to correlate that, the crypto markets are also very close to current all-time highs, including Bitcoin and Ethereum and a bunch of the other top ones. But it seems like, again, with market sentiment being kind of a mixed bag right now, and a lot of the high flyers being down so much, I know we talked a little bit about this on the last show, but I want to revisit it and just talk about why are markets still at all-time highs despite kind of a mixed bag and a lot of blood in certain areas of not just stocks, but also crypto, where a lot of cryptos are also down over 50% from their all-time highs. But specifically on the stock side from you guys, I want to hear what your thesis is, why things are still up so much, I guess, on the indices, not just the NASDAQ, but also the S&P and the Dow, and even the Russell is pretty close.
Yeah, I think we talked about this a little bit over the past couple of weeks, but the indices are actually a poor indicator of what's really going on in most of the broad market. A lot of the indices have 20 or 30% of their weighting in 4 or 5 large mega cap tech stocks. And so they're actually a little bit misleading. Like I think even last week when we were in the depths of the stock market correction, there was something like 400 or 500 stocks on the NASDAQ index were down more than 50% year to date. And yet you had the index only down, I think, like 4%. So the difference is the market breadth. Most of the stocks, like the thousands of stocks that trade on the exchanges, are not making up a heavy weighting in the actual NASDAQ index itself, the NASDAQ 100, for instance, or even the S&P 500. So the Apples and the Amazons of the Google and Microsofts of the world are still holding up, and therefore holding the indices up. But there's carnage underneath the surface with hundreds or even thousands of stocks that don't have that large weighting in the indexes. So that's really the story. It's amazing. There's some great charts and figures out there too about market breadth that we've seen over the past week that illustrate this. And we can show some of those, but it's basically a story of, the mega caps at the top holding up the indexes while the rest of the market has seen a massive pullback.
Yeah.
Yeah. Well said. I think that something similar is also happening in the crypto markets where, when you look at some of the top markets like Bitcoin and Ethereum and Solana, a lot of these are still within reason of their all-time highs, where a lot of the smaller caps, sure, on the way up, just like in the stock market on the way up, they have bigger percentage gains. But on the crash, those are the ones that you see down 70, 80, 90% or more. So I think, in times like this, it makes sense to be extra prudent on not doing things like over diversifying, right? Like my motto is trade less, profit more. What that means to me is not just trying to be overactive and trade a whole bunch of shit coins, right? Have hundreds of positions on things that are super risky and in a bear market are likely to not only be down a huge percentage, but maybe even die, and concentrate positions where they have the highest probability of longer term success, where I can have confidence to have a 30, 40, 50% drawdown in Bitcoin or Ethereum or some of the other large ones. How do you guys tend to think about that in today's market? Are you trying to be super concentrated or diversify even more or somewhere in the middle? How do you guys think of that?
Yeah, it's interesting. The crypto market is definitely different from a macro structure standpoint. Like with Bitcoin and Ethereum having, significant network effects, you have even more concentration of market cap at the top, I believe, than even, an index like the S&P 500, for instance. So it would almost make sense in some strategies to be, more concentrated in crypto. Whereas with stocks, like there's so many different fundamental factor buckets that you can allocate to. I think you can actually reduce risk and still maintain return if you know how to kind of diversify among those. We've talked about like portfolio construction in our stock boot camps and things like that, where we look at how the effects of correlation can actually reduce risk without reducing return, you're getting kind of a free lunch with some diversification when you diversify among uncorrelated assets or even uncorrelated factors. So we try to stay actually somewhat diversified. Like I'm not putting, 100 stocks in the portfolio to where I'm just going to end up with the same return as the overall market, but I'm also not concentrating in 2 or 3 stocks. So we try to find that sweet spot between say 10 and 30. We try to, have different buckets, different factor exposures. So we're not just exposed to high growth, high valuation stocks. We got a couple of growth stocks in the portfolio. We got a couple of value stocks in the portfolio we like. We got a couple of special situation type stuff with like the SPAC warrant trades that we've talked about. So we try to construct it to where we think we've got a good opportunity to get returns in kind of any market environment. But there are other approaches. There's a lot of ways to make money here, and I know some portfolio managers like to concentrate in their best ideas when stuff hits the fan in markets, and that can work too. It just really depends on what your strategy is and how good you are at employing it.
Yeah, absolutely. And I think in the crypto market, the thing that I tend to focus on in times like this is my different capital buckets, right? So because, look, how many stocks are there out there to trade? Over 5,000, right?
Thousands.
Yeah.
Globally, I think it's 40 or 50,000.
Mm-hmm.
Yeah. I mean, if you look at if we get rid of like penny stocks and, frontier markets and things like that, like actual companies that are doing billions in revenue, there's like a few thousand, right?
Yeah.
Where in the crypto market, depending on what camp you're in, you might be super tribal and say that Bitcoin is the only crypto, or one of these challengers is going to, overtake Bitcoin and we're going to have a flippening of some sort. I don't really care about those arguments. I step outside of those tribal discussions. And, even recently there's like some of the Bitcoin copycats, which I'm not even going to mention. There's infighting in the Bitcoin community between the block wars or the BSV wars or whatever. Like, instead of me getting caught up in those discussions, I just take a step back and say, okay, which ones obviously are going to have the biggest network effects, right? Bitcoin has first mover advantage, Ethereum shortly after. And then depending on where we are in the market cycle, do I want to be more heavily weighted towards cash because I think we're going to see deep drawdowns and I want to have cash to buy when prices are down 70, 80%, like they often are in crypto market cycles? Or do I have a lot of conviction and upside potential? And sometimes I'll have less than 5 or 10% of cash in my crypto portfolio, right? And so right now, when things are kind of a mixed bag, as a lot of people watching the show know, I've taken a lot of profit off the table this year. But I'm also buying dips. I'm also looking to buy breakouts on different projects. And I've started to scale into multiple positions over the past 2 weeks or so. So it's like a balancing act between having these short-term trades where you can make a lot of money in, a few weeks or a couple of months, and also keeping your core positions intact and letting the ebb and flow of, like, do I want to be heavily in cash or heavily in crypto, right? It's like a wave that kind of goes with the market cycle. I don't know if that's confusing or not. I guess I'm kind of thinking out loud with that, but that's how I tend to think about things, is not from a tribal standpoint or, the biggest question I get from crypto rookies all the time is, what's the next hot thing, right? Like, what should I buy? And I don't really think of things in that term. I think more so in like market cycle terms. And I don't try to guess which projects are going to win long-term. I just let the chart do the decision-making for me, right? Like, where are the inflection points? Where are the trade setups? Where do I feel like I have asymmetric risk to reward? Things like that.
Yeah, I think that's a really interesting way to approach it. And even on the stock side, this idea, if I can maybe rephrase that, like this idea that you have the capital bucket that's a longer term, core holdings, and then you also have your more opportunistic stuff that you trade around on an active basis. I think even us long-term stock investors, we do that. I have my portfolio that I try to construct. I'll add a couple positions every few months, I'll reduce positions. I'll take even some short-term trades here and there that I think, pop up in the market from time to time. And then we'll take advantage of stuff where we like something for the long term and it may be on, just a short-term dip. Like a great example of that this week was PagerDuty. This was a stock that was a $55 stock after Q2 earnings. It reported great Q2 earnings. The company accelerated its growth rate into the 30% range. Wasn't an egregiously priced software stock. It wasn't like a value stock either, but it was a reasonably priced growth stock. And then it just proceeded to get hammered over the last quarter. And part of the reason I think is because ARK was a large holder of this stock. They're one of the largest holders of the stock going into Q3. And, ARK was selling a lot of stuff as they're seeing outflows. So there's like this forced seller in the stock with PagerDuty, got cheaper and cheaper, even though the fundamentals weren't changing. Then they go and report earnings yesterday. And of course, they showed continued acceleration in the business, growing over 30% still. Everything looks great. The only thing that's changed is ARK has been selling the stock down to a cheaper valuation. And we had been nibbling over the past couple of weeks. And, sure enough, we get good results and the stock's up, nicely today. So whether that holds next week or week after, I don't know, but the time to kind of add to that position and make it bigger, given the risk reward dynamics, I felt like was right for us. So that's a perfect example of where we already have a core position, but we can trade around what's happening in the market and kind of that sentiment change. So maybe that's illustrative.
Yeah, I actually just tweeted about this, a form of this. I call it having your cake and eating it too. Chris, the way you described how you have your core positions and then you trade around them, it's essentially a way of having a core satellite portfolio in a way, having that core long-term investment strategy. And then on the outside, you're kind of taking advantage of opportunities as they come. So, yeah, it's having your cake and eating it too. It's active investing, but it's, active investing with structure and with a safety net in a way. So this is the way I approach my portfolio as well. So I think we all kind of have different versions of the way we do that. And, but it's definitely a way to capture that return and that market generating return or whatever Bitcoin does over the next decade or whatever it is, capturing that with that long-term part of your portfolio that you're probably not going to sell for a very long time, and then working around it to add that alpha or add that return, that oomph to it.
Yeah, that's a great point. Just like people are tribal about certain stocks or certain crypto projects, they can also be tribal about investing strategies too, right? Like Nick, I think you've done some funny videos about, some people that say, passive index funds are the only way to go, or day trading is the only way to go, right?
Yeah. Oh yeah. I mean, I see it all of the time. And even in the finance space, the personal finance space, I see a lot of people that are literally passive investing is the only way. And if you do anything but passive investing, you're an idiot. And they are sure to tell you that. So it's like, I think that people do get tribal about their strategies, but there's a way to take advantage of multiple strategies and diversify across multiple strategies. And you can, have your cake and eat it too, like I'm saying. Because look, naturally, most people should just be investing passively for the long term, whether it's in crypto or whether it's in stocks or bonds or whatever you want to invest in, right? Most people are going to be that way. But for the population of people that are interested in this and want to do this and want to generate higher than regular market returns, or they do want to do some stock picking because it's fun and because it's exciting and because they're interested in it, there's nothing wrong with that. And I think even adding a crypto allocation, a small crypto allocation to a passive portfolio, could add some extra return, over time. I think that that's becoming a smart move for people to add a little bit of crypto, specifically Bitcoin and Ethereum, into their portfolio. So I'm seeing it from even like my friends who have nothing to do with investing. They have a 401k at work and they're like, hey, I want to get some crypto. And I'm like, great. I think that might be a wise idea. So there are so many different ways to skin a cat and approach this. But I think that getting too tribal over one specific strategy is that could be detrimental to your wealth basically over time.
Yeah. Yeah. I mean, look, I'll give you some examples of mistakes I've made and like successes I've had because I was either tribal or I stopped being tribal, right? Like for a very long period of time, I was a day trader, right? And that was my sole focus, was trying to find alpha through day trading. And I gave up a couple of years of early Bitcoin gains because I was overly focused on trying to day trade the stock market, right? Where I made a lot more money was saying, hey, maybe if I zoom out and I go heavier into Bitcoin and some of the earlier cryptos and hold for swing trades and multi-year position trades, maybe I'll actually make more money doing that. And I did, right? So I think if for anybody listening to this or watching on YouTube, if you think about maybe where your focus is and try to find blind spots or where maybe you've ignored certain strategies or certain areas of the market, and I tell crypto people all the time too. It's like, yes, we love Bitcoin, crypto's great. It's growing fast, right? All that stuff. But if you're ignoring the stock market, I think that's a big mistake. I want to own a piece of the most profitable companies in the world, the fastest growing companies, we've talked about this endlessly on the show, but I always like to bring it up because I know there's a lot of crypto people out there that are very dogmatic and very anti-stock market, just like there's stock market people that are very anti-crypto. And I think people that are on the fringes of both sides are equally wrong. And if you understand that you can make a lot of wealth or build a lot of wealth in both areas, and by employing multiple strategies, I think maybe that's a smarter approach. The less dogmatic, the less tribal, the more money you're possibly going to make over your career as an investor or trader.
It's also about risk, the risk that you're taking on. And if your strategy, you're tribal over your day trading strategy or your crypto strategy or whatever it is, you got to realize that you are taking on a specific amount of risk. And by diversifying those strategies, you help reduce risk. So that's important too.
Yeah, good point. Trav, any final thoughts on that before we get to the Q&A?
No, I think you all made great points. I have nothing to add.
Well, I do want to ask you guys a question though, because we got a question that I think would be a great conversation. So why do crypto drawdowns hurt less? No, let me rephrase that. Why do stock drawdowns hurt more than crypto drawdowns?
Oh man. All right, I'll give my answer.
It's true. Go ahead.
Yeah. Because in crypto, we have learned to have nerves as cold as icebergs. And, I always say, like, if you can't stomach an 80% drawdown, get out of crypto because you're going to lose your mind, right? Everybody likes to think, oh yeah, man, I should have just bought Bitcoin in 2010 or 2012 or whatever. And I for sure would have held this whole time. Yeah, right. Very, very, very few. I would say 1 in 100,000 would probably, who bought in 2010 would have held through all of these bear markets, right? It's very easy. Hindsight's easy, but the longer you're in crypto, the easier it becomes to hold through drawdowns. That's why I always say, like, position sizing matters, right? Like, if, let's say you've built a $10 million crypto portfolio. My question would be, what would you do, or how would you feel, or how would you behave if you drew down 8 million of the 10 million, right? Would you be able to stomach that? And nobody can answer that except the person thinking about it, right? So every person that's listening to this now, ask yourself, okay, I got to say a $10 million portfolio. Would I be willing to draw down $8 million of that? If not, your position size is too big and you might want to think about taking some profit off the table. That way, if prices did come back down, you could buy back at lower prices, right? Now, it's a balancing act because if prices keep going up, there's potential future gains that you could miss out on. That's the challenge and the joy of trading, is you are making high risk decisions with incomplete information based on an uncertain future, right? But I know long-winded answer. I'll finish it up and pass it to you, Trav. But I think in crypto, we're just used to deep drawdowns and they hurt less because we're like, old salty sailors who have been through the shit over and over and over. But Trav, why do you think maybe stock drawdowns hurt more?
I think we'd have to look at the data on this, but my intuition is that stock drawdowns take longer to recover from when we're talking about, broader market drawdowns, because, crypto, like you said, has had a lot of even 20-30% fast corrections and then snaps back really quickly. So I think that's one component. In the stock market, we say that the stock market likes to take the stairs up and the escalator down, or the elevator down. So we have fast corrections in stocks, but it takes longer to recover. With crypto, it seems like the recoveries can happen pretty quickly. You can have a quick flash crash, but then it's, back in a couple of days. So that may be part of it, is how quick crypto is to recover. But then also, I think crypto is also seen as an asset class where, there's this longer term future vision. And a lot of people, I think, believe in this idea that 5, 10, 15, 20 years down the line, crypto will be much, much bigger. So, they're willing to hold through the drawdowns in the short run, perhaps, or handle those because they know that ultimately, in the longer term, the belief is there that will recover. On the stock side, I think that's true maybe in some companies, but it's less clear in others. And so, there are lots of examples of companies that go out of business, that go bankrupt, that have to dilute shareholders. And so you have a lot of situations where a lot of stocks don't ever recover. So maybe that's part of it too, is just the general optimism about crypto as an asset class versus, stocks that can definitely go to zero.
Yeah, good points. Nikki, what do you think?
I think that I agree that people have been trained in crypto to just be able to stomach it. And it's almost like this is the way it should be in stocks, actually. Like, this is what we try to train people. Like, hey, corrections are going to come. Drawdowns are going to be a part of life in stocks. Like, it is what it is. But over time, historically, we've recovered from these drawdowns, right? But crypto people just know it. It's just ingrained in them. Like, yeah, I'm going to get into this crypto. We're going to see drawdowns. It's going to be great. I'm going to buy the dip. Like, that's how people should be thinking about stocks, but for some reason they don't. And it's almost like, I also think a part of it too is I haven't looked at the data on this in terms of how many drawdowns or specific, percentage corrections Bitcoin has had versus the stock market measured by the S&P 500. But it also feels like the S&P 500 doesn't really correct that much. And when it does, when it does have those vicious corrections, 2008, you can remember them. There's two of them recently, like 2008 financial crisis, 2020 coronavirus pandemic crisis, right? Like, those are like the two main corrections. And there's been some along the way, but when you look at the chart, I mean, it's the S&P 500's pretty much gone straight up for a very long time. And so it's almost like investors, you see that markets in turmoil headlines start to come up when the stock market's down a couple percentage points. It's ridiculous. It's like, even the correction we just saw over the past couple of weeks was nothing. It was nothing. I'm like, why are there headlines over this? This is ridiculous. This correction is nothing in the S&P 500. So I just think that we've been programmed in stocks that, like, stocks always go up. Corrections don't happen as often. They're not as deep on a percentage basis. When you do get that 40-50% correction in stocks, something really, 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 really bad is happening, right? Like, but crypto, it's like, down 40%, no big deal. It's just a Tuesday, evening, and we're down 40%. So I just think that the dynamics between the two are very different. And also, investors came into crypto trained the right way.
Yeah. And I just pulled up here on Y charts, the drawdown, the max this goes back is basically 2015. So obviously there's more data than this, but just over the past 5 or 6 years, Bitcoin's had a drawdown of over 75% a few times, right? So again, think about that. $10 million portfolio at the high. Imagine you're down 7.5 million from that all-time high, right? Like, look at your little portfolio app and think about what that would feel like to have that 10 million in there. And then think about what it would feel like to have, 2.5 million. are you going to have the confidence and the conviction to buy after a deep drawdown like that? Or are you going to do what most people do, which is say, I can't take the pain. I'm going to fucking just sell it all at the very bottom and, and then say that crypto is a scam and move on and go work at McDonald's, right? Like that's why crypto is so hard, but that's why the upside is also so rewarding because it's high volatility. And the CAGR has been so great. I mean, we've been compounding at almost 200% annual returns over the past decade. So it doesn't get much better than that.
Which is crazy.
Yeah.
No.
But it doesn't come without its issues, right? Again, you got to be able to hold through those drawdowns or buy at the lows, right? Which most people just can't get themselves to do. All right. I know we've been going for a while. We've got a few good questions here. There was actually one from Twitter that actually a month ago, Talon Blood said, my mother-in-law's financial advisor reallocated out of a 60-40 bond, 60, I assume 60 stocks, 40 bonds to 85% stocks, 15% bonds. Is this becoming a new normal for retired fixed income people? So basically taking people that are close to or at retirement and instead of a 60-40 portfolio, bumping their risk all the way up to 85% stocks, right? And taking profits at all near all-time highs are the same thing to do when you're up 10x on a cost basis. So I guess that's a two-part question, but Nikki, in the financial planning space, is this becoming more of a trend where people at or close to retirement are being pushed into higher risk allocations?
Absolutely. It is. It is becoming a trend because there's no yield. There's nowhere to get yield. Bonds have become a tough place to be. And inflation has been increasing. And so you are kind of trying to battle both of those things. And managing that for a retiree is actually very challenging. I feel very bad for a lot of advisors right now because they're in tricky situations. I mean, you're having to put more risk on for your client, and that's always going to be something that doesn't always feel very good. But unfortunately, we have to take whatever market environment we're in and we have to work with it. So what a lot of people are doing is they're thinking about what money the client needs now or in the next 5 years, right? They're taking that money that they're going to need over the next 5 years or so, and they're investing that and keeping that in the bond allocation. And then what they're doing is with the rest of it, 5 years out, plus that money is being invested in stocks because it's going to have more time to work. So that's kind of how advisors are thinking about it because their hands are just kind of forced right now. I mean, you can keep a client in, and also this totally depends on risk tolerance too. Some people have the risk tolerance for that and some people don't. But at the same time, the client has to protect the purchasing power, or the advisor has to protect the purchasing power of the client too, right? They have to make sure that they can actually survive retirement. So yes, this is a common thing we're seeing. I think an 85-15 is quite aggressive. That's actually very, very aggressive for someone who is either approaching retirement or in retirement. But at the same time, I don't know the situation. There could be multiple things that are going on there that could warrant that. Maybe they have a lot of assets and they're not going to need a lot of those assets. And so that's why they're doing that. They could have pensions that are coming in to help support their paying their bills. So a lot of factors could be at play here to warrant an 85-15 for a retiree. But yeah, it's becoming more common.
Interesting. Travis, I got a question for you. Somebody was asking, are you a picky investor? Would you consider yourself a picky investor?
Oh, yeah, absolutely. I mean, we talked about it earlier. Stocks, there's thousands of potential stocks to choose from globally. So I've got to be picky, I'm probably not picky enough though. I mean, I have, I think right now, 25 or 30 stock positions, and, realistically that could be at 15 or 20 with still pretty good, opportunities for returns. So there's been times where I feel like I've had too many positions and I'm too unfocused. So I could even be pickier probably. There's not that many businesses, when you look at the data historically, there's not that many businesses that can compound at 25 to 30% a year for 2 decades, when you look at the sample size of companies that end up being, these mega hits that deliver massive returns, it's 2% of all companies deliver like 95 or 98% of the stock market's returns over a longer time frame. So I think it's important to be picky and to try to do the research and not just like get into every company that looks remotely interesting or you hear on CNBC. I think you do yourself a disservice if you're trying to constantly hop between too many stocks. So I'm pretty picky. I could probably be even pickier, and I don't think that's necessarily a bad thing.
Yeah, I feel like I'm pretty picky too, which is why 100% of my stock portfolio is in Tesla.
Oh God. Here we go. With
just
the
kidding.
fanboy.
Just kidding. Yeah. Papa Elon can do no wrong, can he? What would you say the other day, Trav? They don't arrest billionaires in the US.
That's right. That's right. Billionaires are above the law here.
Yeah.
It's funny though, because I was thinking about this the other day, and actually it aligns exactly with what we were talking about earlier in the show as well, which is, you can make the case for a company and say, even if you believe in all the things that Tesla's working on and that they're going to be much, much bigger in 10 or 20 years time frame, you could say that at any price. If Tesla went to 10 trillion, 20 trillion of market cap, 100 trillion of market cap, right? You can still say Tesla's underlying businesses are going to grow over 10 years. So you can't just ignore price, right? Like, it doesn't make sense that you'd be buying Tesla at $100 trillion market cap, larger than the GDP of most countries in the world, right? So the price that you pay does matter. And so I think like that's something that a lot of people lose sight of on Tesla when they're like innovation, the future, EVs, energy, robots.
It's not just a car company.
Yeah, exactly. It's like, okay, but tell me what price it does get expensive at. There has to be a price at which it gets too expensive.
Yeah.
And so that's something I think investors often forget when they get focused on innovation and companies that are cool. And, a lot of those companies can do great over time, but that's also how we find ourselves in bubbles where companies get massively overvalued. Looking at you, Tesla and Rivian.
Should we make Tesla price predictions? Could be fun.
Let's do it.
I don't think you want to hear my prediction.
I do. Absolutely. I freaking
throw it
do.
out there. Say a price and a date, and we'll timestamp it and see how accurate it is.
Well, I think the fundamental value of Tesla's worth is probably going to be a lot different than what the market will value it at. But I think Tesla should be no more than like a $200 billion market cap today. So that's very far off from where it is. It's about a 75-80% drawdown from where it's at now.
All right. Well, there you have it. Trav has shorted 100% of his portfolio against the Tesla stock.
Absolutely not. That's the other thing, though. Is just because you don't like a stock and you think it's crazy overvalued doesn't mean you have to be shorted either, because it can be very dangerous to be short some of these, cult favorites.
Yep. All right, let's do this. We got a couple more questions and then we'll wrap it up. Tori was asking, do I need life insurance if I have kids? And if so, how much? Nick, do you want to take that one?
Yeah, good question. The way you want to go about life insurance analysis, period, is if something happens to you, is there somebody depending on you for money or to survive or whatever it is, to be able to pay the mortgage that you left them or whatever? Like, is there somebody that needs that help? And if that's the case, you probably need some life insurance if you don't have enough assets to kind of self-insure. If you have a ton of assets, millions and millions of dollars, then they're going to inherit that money. They'll have that money to take care of themselves, whatever, right? That could be a way for you to take care of it and self-insure. But for most people that have children and they're still in the wealth accumulation stage, and if something happened to them, those kids relied on them, yes, you're going to want to think about getting some insurance. And the way to determine like how much insurance, you don't necessarily want to go overboard with it. You want to look at your bills, look at what your children need to kind of go to school and have everything that they need and be supported, and how much is that annually up until they are adults. And then do that math and figure out, okay, are they going to need money to, pay for the house that I leave them and pay the mortgage, pay this, pay that? do all of that math and figure that out and kind of get a rough number of how much you would want your kids to have to be able to survive until they get to a point where they can be self-sustaining adults and get out there and get a job and all of that. So that's kind of how you do that analysis.
Awesome. Last question. Nipper was asking, it would be good to get your take on donor advised funds as a tax efficient vehicle. And Nikki, I guess that's one for you as well. And maybe you want to explain what those are and what that means.
Yeah. So a donor advised fund is a fund that you can contribute to and get a charitable tax deduction for contributing to it. And then what you can do is you can get the deduction now, but you can advise on what charity the funds go to later. And they've become quite popular recently over the past few years. I mean, they've been around for a while, but you're seeing a lot more about donor advised funds in the news. I think Jim Cramer could have something to do with that. But essentially, you really need to consider if you're truly charitably inclined. You don't want to just do this for a deduction. You want to do this because you truly are charitably inclined. And the benefit of that is the deduction. But something to consider, this is a big one, and this is what a lot of people miss, is right now with the way the U.S. tax structure is, if you're not going to be contributing more than the standard deduction, which is $12,400 for a single person or $24,800 for a married person, if you're not going to be contributing more than that, it could not even help you out. Your deduction could not even, help you out at all. So definitely get with a tax accountant and do the math. And, if you're contributing, a lot of money, way more than the standard deduction, it could definitely help you out with taxes. But some people, if they're just contributing a couple $1,000s or, whatever it is, it might not, the deduction may not even help you at all. And it depends on your tax situation. But yeah, they're great. They're great vehicles, very popular for charitably inclined individuals who also want to get that tax deduction.
Sweet. There you go. All right. I want to wrap up with one question that I had for you guys. And I've been watching a show that I really like, and I just wanted to talk about it. And I wanted to see if you guys have been watching anything. The show that I really like that I'm totally hooked on, and I want to rewatch it like 5 times, is called Yellowstone. It's got Kevin Costner in it. Super badass. It's about basically a family that's owned, I think, the largest ranch in the Montana area for like centuries. And it's about the battles that he has trying to keep control of that land. And just I think a really great show. Trav, what about you? Have you been watching anything?
Actually, we got into Yellowstone recently as well.
Nice.
Love my boy,
the only one
Rick.
that hasn't seen it.
Yeah, dude, I think it's one of the best shows I've ever seen. I'm not a huge like TV guy, but that show is just like awesome. Nick, what about you?
I mean, we were watching something yesterday. It had Kevin Hart in it. He murdered somebody.
True Story, I think it's called. Yeah,
I'm actually kind of into it. I'm kind of into it right now.
Cool. All right. Well, that's it. We're not huge TV people, but I figured I'd mention that anyway.
I do need to watch Yellowstone for sure.
Yeah, you got to get caught up.
It's a great one. The other thing that we've been into the past week has been rewatching all the Christmas episodes from The Office. Yeah.
Of course. Of course. Wait a minute. For people that don't know, Travis knows like every single word from every Office episode that ever exists. He would win an Office trivia like that, basically.
Yeah, I don't know if there's like a nationals for Office trivia, but if there is, you should definitely enter it.
I did create my own database of Office trivia questions. So,
oh my
God, of course you did.
You would.
Love it. All right, guys. Well, thanks for joining us today. Hopefully you got a lot of value out of the show. We certainly enjoy doing these. And Yeah, we'll see you next week. Thanks to Y Charts for sponsoring the show. Feel free to go to wetalkmoney.com to submit a question for the show. Also go to wetalkmoney.com/community if you want to check out our wealth building community, where we have a Discord chat room. We do alerts. We do weekly classes. We have all the fun things in there. Check that out. And if not, we will see you next time. Take care, guys.
See you.
Ciao.